Here's the global view from HSBC, warning that the risk rally has come too far too fast, writing in a note this morning the following. Expect global growth to remain subdued in the coming quarters and a significant rebound in the data that seems unlikely. This then means that the current outperformance of risk assets, such as global equities versus global sovereigns, may have to retrace in the coming 3 to 6 months. Kate Moore, your view on that?
So I think what's driven the market this year are 5 things. I mean, obviously the Fed and the sort of the change in the narrative, the progress, or at least perceived progress on the U.S.-China trade talks, the fact that the data didn't come in as badly as some people had expected, the reversal of some of the technical and liquidity positions from the fourth quarter, and then finally, I would say on earnings, which is getting completely overshadowed by the trade stuff. Again, I want to come back to this because the fundamentals actually look better for most of the U.S. large cap space than most people expected.
Relative to the earnings recession call at the start of the year.
That's right. There were a number of people making a really loud call for a profits recession, that things were going to be very weak, under recognizing the ability companies have to really control their costs and to offset slightly higher wages in the tighter labor market with investments in technology and other things that lead to, frankly, better efficiency gains. So I think that's a good and important story. If that remains in place and we get some stability on the policy side and on the trade side, I think equities can move higher.
And that keeps the U.S. story quite insulated, just in terms of the hierarchy of vulnerability. Still at the top is China and Europe. And I think we've come into a year where the price action abroad has actually been pretty decent. And decent, Krishna, because so many people thought back half of this year that holds the key to risk and I want to get ahead of it. We're going to stabilize. We may even accelerate. The hopes of that happening now, Krishna, how hopeful are you?
I still am very hopeful. I think the underlying monetary and fiscal stimulus in the U.S. and China, respectively, is still very much in place. So I think back half of the year is going to be meaningfully better than what we have seen in the fourth quarter. You know, the first quarter was one-time things like inventory and stuff like that. So we probably don't beat that. But I think the back half is still going to be good. The vulnerability with respect to trade talks is something that we cannot ignore. But that's really not the key point. Let's say we have a downtrade in 10%. The real question for investors is, what do you do then? And I think in that context, what do you do then is buy rather than sell, because the markets are probably going to go higher from that repricing of the markets. And the drivers are essentially the same: China stimulus and U.S. Fed policy.
George?
Yeah. I mean, capital markets are the key, as we mentioned before. And I think, as Kate mentioned, earnings look pretty good, but the power of low interest rates matters quite a bit. And when you have a large portion of the world still facing negative yields, they're trying to recycle, and savers are trying to recycle that money just about anywhere they possibly can. A lot of that money has been coming onshore into the U.S. The Fed has kept rates low, and companies and individuals are benefiting from that lower rate structure. That is one of the most powerful mechanisms in the system right now.
To go to Krishna's point, and I think it's a valid one, and most people watching this program will agree, the most important things over this whole cycle: Fed policy, Chinese stimulus. What will unsettle some people is that over the last 12 months, we've seen some evidence that the Chinese stimulus is becoming less effective. The character of it has changed. You've pointed that out, Kate. But the stimulus itself is carrying less bite. For every dollar of debt you plug into the Chinese economy, you are not getting the same bang. Does that not concern you, Krishna?
Of course. So I think Chinese growth is slowing down, and it'll continue to slow down, irrespective of how much stimulus they put into the economy. That is not the critical point. The critical point is it going to fall off a cliff? And as long as it doesn't fall off a cliff, you know, they're creating a long-term problem for themselves by continuing to stimulate the economy. But you can't ignore that as you're pricing risk assets today or for next year and the year after next.